Good evening, ladies and gentlemen. Welcome to the EY webcast on Decoding Union Budget 24-25. Last few hours been very exciting, full of twists and turns. Before we start, I request all of you to post your questions in Q&A box so that our panel can address towards the end of the session as time permits. I know I'm standing between you and my expert panel. So without taking much time, I would like to invite Mr. Samir Gupta, National Tax Leader, EY India, to open today's session. Over to you, Samir.
Greetings, everyone, and a very warm welcome to EY India's Budget Day session. As we had discussed in the run-up to the budget in our pre-budget session last week, there was much anticipation to the first budget of the Amrit Kal. And if you've been spending time looking at the various measures that have been announced, there's a lot to cover today. So take us to all of this. We do have our panel, which has come together today. I will make a few introductions quickly. We have with us Mr. Arnav Roy. Arnav is the Chief Financial Officer at Maruti Suzuki India. Welcome, Arnav. We also have with us Dr. D.K. Srivastav. Dr. Srivastav is the Chief Policy Advisor at EY India, and he's also part of the advisory committee to the 16th Finance Commission. We are joined by Ganesh Raj, and Ganesh is our National Leader for Business Tax Services, and Uday who is our Indirect Tax National Tax Leader. So with that, let's get moving to the slides. So very quickly, we'll cover the budget backdrop, and then we will cover the policy announcements. Dr. Srivastav will speak through us through the macroeconomic considerations, and then we will cover off the direct and the indirect tax proposals. As a backdrop to the budget, if one looks at the global economy, the global economic headwinds continue to persist in the past year. The global supply chain disruptions continue to affect trade supplies. Inflation continued to be stoked, especially by services inflation. And I think elections in all major economies are leaving a lot of uncertainties. In that backdrop, India continued to be a bright spot. We've been able to cover a 8.2% GDP growth in FY24. And it clearly is emerging as the fastest growing global economy on a consistent basis. We've also had very robust growth in our tax revenues, which we will cover in greater detail as we go through the macroeconomic slides. From an overall perspective, the growth for FY25 is now being pegged at 7% plus minus. In the backdrop of all of this, the economic survey was tabled by the finance minister yesterday. The story was all rising and shining. India continued to be demonstrating its resilience. The headline inflation is largely under control. The trade deficit was lower this year, which was facilitated by a great expansion when it comes to services export. And from a foreign exchange reserves positions perspective, we are front covered for 11 months. CapEx expenditure continued to be substantial over the years, and that has resulted in massive capital formation. The banking and finance sector also, with a number of reforms that have been taken over the last couple of years, has come with a 2.8% GNPA in March 24. So the NPA is at almost like a 12-year low from the numbers that we've seen. The stock market has facilitated, of course, a number of IPO issuances. When we look at some of the other aspects of the economic survey covered, and there is a big call out in terms of the vision for New India. A couple of points which we would like to highlight over here. One, and again, this was covered in the speech today as well, the focus that is going to be there from a labor intensive sector perspective, as well as in terms of job creation and the role of the private sector in job creation was again a large point of discussion. Statistics shared did seem to indicate that 1 out of 2 coming out of the colleges are not ready for employment. And therefore, from a skills development point of view, the focus really needs to sharpen. From a agriculture sector perspective, again, several announcements were made, and there was a call out with respect to improving credit to agriculture, as well as better price discovery, as well as better logistical movement for commodities. MSMEs, again, was a call out in the economic survey. This is more to do with better regulation, enabling environment, as well as connectivity between the physical and the digital infrastructure, and also in making credit available to MSMEs, given that several MSMEs lack proper credit history as well as collateral. Greening growth was another focus area that was covered. I think in all of this, if everyone puts the dots together, a lot of collaborative effort required between the union and state government and the private sector. And if we move on to the next phase, which is really the policy announcements, and again, there were several points that were discussed over here. If I was to try and summarize some of the key points, while the minister did indicate that a lot of focus needs to be in 9 priority areas, from an infrastructure perspective, the budget allocation which was there in the interim budget has been maintained, which is an 11% increase over a 33% increase in the previous year. From an employment perspective, like the economic survey, there was more detailing around how this would be brought to bear in terms of new employees coming into the formal sector, providing sufficient financial support by doing a direct benefits transfer of 1 month wages, as well as from an employer perspective to facilitate employment generation, EPFO contributions being reimbursed by the government was discussed. A very novel idea in terms of getting the new employees up to speed and up to skill by creating internship opportunities, by creating employment in top 500 companies was also spoken about. And if we move to the next slide, couple of other points which were also covered was around manufacturing and services. And again, this was more to do with now taking the DPI population at scale benefits as well as outcomes from that and taking it into the private sector by creating DPI application developments in various areas that we put on the slide, as well as working with industrial parks in nearly 100 cities. MSMEs, I just spoke about that. A lot of that was to do with how do we create credit guarantee schemes to get MSMEs the desired amount of credit. And lastly, from an ease of doing business, the Jan Vishwas bill is supposed to be tabled. A lot of work is going on by the DPIIT in this space from a perspective of exits. Just as there is a corporate accelerated scheme in place, there is also now going to be a voluntary closure for LLPs, which will be activated. Insolvency and disputed debt resolution has been another large area that the government has worked on. So there is a mention of additional tribunals being set up in this area. And lastly, from a FDI and from an overseas investment regulations perspective, there is going to be more announcements from a simplification point of view. And to give an impetus to the internationalization of the rupee, there is going to be focus on regulations where ODIs can take place with rupee as the currency for overseas investments. So with that, I will move now to the next part of the discussion, which is really where we get into some of the detailing around the numbers. And if you would recall, when we had the pre-budget session, we discussed that the main trade-off seemed to be between expansion of capital expenditure and the growth in capital expenditure versus a reduction in fiscal deficit to GDP ratio. So let's see how the finance minister fared on that. For that, let me bring in Dr. Srivastava.
Thank you, Samir. Thank you very much. Well, let me begin with considering the growth performance of the Indian economy after the COVID shock, which had led to a contraction of near 6 percentage points. After that, the Indian economy actually brought about what I would describe as a robust, sustained and smart recovery, in the sense that this is the 4th year in running when we are either close to 7% or above 7%. So 9.7, this is shown in the lower curve on the left-hand side, 9.7, 7, 8.2 and 6.8% being the economic survey number, as it were, because the budget does not give a real GDP growth estimate. It only gives a nominal GDP growth estimate, which is given as 10.5%. When we were discussing the interim budget, and we were wondering whether the final budget will give a number of 11% or 10.5%. Clearly, because the economic survey has given a number in the range of 6.5 to 7%, which is giving an average of 6.75%. To that, if we add a implicit price deflator of 3.5%, we will get 10.5 and not 11. But this 10.5 has implications for revenue receipts, to which we shall turn to in a moment. But on the right hand side, we just notice two features of the structure of output in the economy and structure of demand. The weak part of the structure of demand is actually in terms of consumption expenditures. The private final consumption expenditure and the government final consumption expenditure are both shown to grow only at 4% and 2.5% in FY24. So if a correction was needed, one would have expected some stimulus to consumption expenditure. We'll see whether that has come about or not. On the output side, the relatively weak performance was there for agriculture, and it had shown a growth only of 1.4%. Luckily, the monsoon are on course, and the expectation is that this year agriculture may show a growth in the range of 3.5 to 4%. So in that case, agriculture might do well, but it is consumption expenditure on the demand side that would have needed greater budgetary support. Let us see how the fiscal aggregates work out. In the second slide, we will just make a comparison with the global growth performance. And as you can see on the right hand side, the world growth, the global growth is averaging at about 3.2, 3.3%. That is to say, India's growth is actually more than double of this, and clearly India is leading global growth, as was recognized by the IMF. The World Bank is also saying a growth possibility of 6.6, but IMF and the RBI have both said 7 and 7.2%. So the survey and the budget has chosen to be what we might either call conservative or we might call more realistic. But given that, the fiscal aggregates would be worked out, and that is where we move to the next slide and look at the performance of Government of India's tax revenues. We are looking at the growth rate of direct and indirect taxes in relation to the nominal GDP growth. And we find that as compared to FY24, the direct taxes have shown a growth of 12.9%, whereas the indirect taxes have shown a growth of 8.2%. This is resulting in a much higher buoyancy for direct taxes at 1.22 and a lower than 1 buoyancy of 0.78 as far as the indirect taxes are concerned. The overall buoyancy of gross central taxes is just a little more than 1. So this is the performance of the direct and indirect taxes. Clearly, we are relatively more dependent on the growth of direct taxes, which in general would be considered good because we can control the incidence of taxation relatively more through direct taxation. So the next slide would then show the evolution of the tax GDP ratio, which is very critical because that determines the overall size of government expenditure, which is what is a proxy for the government sector's intervention in the macroeconomy. Now here we find that if we look at the last column of the table, the combined tax revenue of the central and state governments has risen from an average of 17.1% over FY18 to FY20 to now about 18.5%. We expect, although we are not giving that figure for the next year because we still await state government figures, but we expect that this would increase further to about 18.6%. So this is made up of gross taxes of the central government and the state taxes. Now, what is accessed by the central government for its own budget is not the gross tax revenue, but what is available after tax devolution to the state governments in terms of net tax revenue. Now, from gross taxes of 11.8% in this budget, net tax revenues that can be accessed is only 7.9%. This is the critical input to the overall revenue receipts for the central government. One point that I would like to make at this stage is that this sharp difference between gross and net is because of the fact that the budget as compared to the interim budget is showing a higher tax devolution for the state governments. And this might be on account of certain arrears. But nevertheless, what can be accessed by the central government is 7.9% in terms of the share of net tax revenue. Then we move to the next slide so that we can more clearly spell out the budget arithmetic, which is what can be derived after we have taken into account the thrust of the budget or the supposed thrust of the budget through capital expenditure growth. So the expenditure profile indicates that as we focus more and more on fiscal consolidation and reduction in government debt, we will expect a reduction in interest payments, which has been a part of the strategy of recovery after the COVID shock. One or two surprises are there. One is that defense services expenditure growth is negative. Education also expenditure growth is negative. Capital outlay growth has also fallen from a growth of 29.2% to 13.8% in the current budget. So although we continue to argue that the growth strategy is investment based, government investment based, there is somewhat reduced emphasis on investment expansion. And this might have something to do with the more conservative growth assumption that the budget had made. One longer term trend which is to be appreciated is that major subsidies as percentage of total expenditures have been coming down over the years, and that is a fiscal reform that the government has been able to sustain over time. This is a positive directional shift as a result of fiscal reforms. Now we come to the budget arithmetic, which is shown in the next slide. And as you see, the thrust of the budget, if we were to describe it in one phrase, I would say this is accelerated fiscal consolidation. Because in the interim budget, we had budgeted for 5.1% as fiscal deficit, which was itself a considerable reduction from last year's 5.6% of fiscal deficit. But now the budget has successfully estimated to bring it down to 4.9%. That is why this is an accelerated fiscal consolidation. Now, this is brought about by joining together net tax revenues with non-tax revenues and non-debt receipts. Now, the major uplift to government revenue receipts has come through non-tax revenues, primarily because of the RBI dividend. So this is in fact a one-time uplift, and whether it can be continued is questionable. And this is why possibly government has not gone on those directions of expansion of expenditure, which would be repeated year after year, because most of the fiscal room that has become available is relatively 1 year room rather than a permanent additional fiscal space that would have become available. As a result of this, the total expenditure that can be sustained in terms of relative to GDP is 14.8%, which is lower, as you can see, from the FY23 and FY24 budgets. That is to say, the size of government expenditure has come down. The size of capital expenditure has been retained at 3.4%. But if we look at terms of relative growth rates, then revenue expenditure is shown to grow at 6.2% and capital expenditure is shown to grow at 17.1%. That 17.1% is lower than last year's 28.2%. So in some sense, what is being shown here is that the room for expansion of capital expenditure has become limited, and some demands on expansion of revenue expenditures as compared to last year as well as compared to the interim budget had to be accommodated. So from this we can now go to the long-term path of fiscal consolidation. The budget has not ventured beyond FY26 when they say that we will be able to achieve a fiscal deficit of less than 4.5%. But if we look at the annual adjustment in the fiscal deficits, annual downward adjustment, and project it forward, then there is definitely a clear indication that we should be able to reach an FRBM consistent fiscal deficit target of 3% of GDP by FY28. If we are able to achieve that, and if we are also able to induce the state governments to remain below 3%, then I think that we would have reached a meaningful fiscal consolidation, which would lay the foundations for a solid medium-term growth. So that is the overall thrust of the budget. Some pointers to the social sector schemes that have been accommodated, which is shown in the next slide. We can see that if we look at the FY25 budget estimates, we are net of FY24 revised estimates. We can see some of the sectors where additional expenditure has been provided. We can notice Pradhan Mantri Awas Yojana providing more than 30,000 crores as budgetary allocation, and some of the other sectors that are being supported include the urban economy, and to some extent there is an increase in primary expenditure. So that seems to be the thrust of the budget, and the main message that I would like to leave you with is that whether we could have done more than this in terms of expanding the economy and supporting a 7% growth, rather than thinking of conservative or realistic growth of less than 7%. One directional shift that has been sustained, which I had appreciated earlier, is that major subsidies as percentage of nominal GDP has been coming down. This is the one that has opened space, fiscal space, for expanding capital expenditure and reducing fiscal deficit. So in summary, as compared to the interim budget, the main adjustment in the final budget was to reduce fiscal deficit and to some extent expand revenue expenditure. Thank you, Samir.
Thank you, DK sir. As always, you're able to distill the complex arithmetics in a very lucid manner. So thank you for doing that, and I'm sure we'll come back to you for questions. I think it is, let me bring in Mr. Roy over here. Arnab, if you're here, I would like to bring in your comments about, your perspective. How do you see the overall budget, as well as, all the announcements that came, especially there were several which were made on the manufacturing and the services piece. So over to you, Arnab, and look forward to hearing your comments.
Thank you, Samir. I think I'll first start with where Mr. Srivastav just left. I think the first point which really came was the fiscal consolidation, 5.1 to 4.9. I think in absolute value, it is about 0.7 trillion rupees, this 0.2. And I think if we can continue on the path and it leads to a revisit of the sovereign rating for India, I think that will be probably the best news for the economy. I think so. That's That's something which really stood out. And the focus on the long term rather than short term, I think that was clearly visible from my perspective in the budget. So if you see all the 9 priorities which the government had spent, and and the thrust particularly on the skilling and the education part, I think it will be a welcome move for manufacturing across sector. I think very tangible measures on generating employment, giving a lot of impetus to the industry to hire more. I think those are real positive initiatives which came in the budget. Uh, I think the other one was on MSME, because I think, as you know, our manufacturing ecosystem in India is dependent on lot on the MSME infrastructure. So quite a few of structural, I would say, support given to MSME, which should be positive from an industry standpoint. I think that was welcome. The other thing which stood out for me was the structural steps which the government is announced on energy transition. I think quite a few, I mean, good steps on rooftop solar, to mentioning nuclear, I think, and putting a PPP proposal for that, to some other energy transition proposals. I think we have to still see the fine prints, but I think the intent of the proposal was quite welcome. R&D, I think, again, quite a few good steps on the R&D side, which the government has mentioned, I think, which should be positive. One thing probably, I mean, which some of us were expecting, is a weighted kind of a tax incentive for the R&D, which we didn't see. So probably that's something which we didn't see. But overall, I think, I mean, most of those 9 initiatives, I think, is going to be extremely supportive to the industry. Moving beyond the macro, I think on the direct taxes side, I'm sure you're going to go deeper, but from an industry perspective, I think the simplification initiatives has really stood out. I think that's something which is quite positive, and particularly the endeavor to accelerate and bring closure to the tax litigations and some of the proposals. I think we'll have to still see how it moves in the direction. The fact that a 6 months target has been taken for the new tax code to come in, I think again is a very welcome measure, that probably government is now convinced that we are moving in the regime of revisiting some of the proposals. I think that's welcome. I think on the indirect tax side, I think some of the custom duty thing is definitely going to be supportive for local manufacturing. I think that's another part which is there. So overall, I think, it's quite a positive budget, I think, from an overall industry perspectives. Of course, we'll have to look at some of the fine prints, but I think, to summarize, I think a lot of focus on long term and not going for too much of short term measure, I think, is the most welcome part, along with the fiscal consolidation aspect.
No, absolutely, Arnab. And I think we've spoken about this earlier as well, that, given the resilience of the economy, it is time to create a longer term plan from a sustainability point of view, and to create a sustainable growth plan. And like you rightly called out, the call to private sector and industry to create jobs, as well as, make further investments, and the support and the platform for that is what they've been able to provide. So I think that was very welcome. So thank you for that, Arnab. We will, I'm sure, keep moving along and bring you in as some of the questions keep coming up. So thank you for those comments. And let's move to the direct tax proposals. Ganesh, will you come in for that?
Yes, thanks, Samir. I think I will start with what Dr. D.K. Srivastava said, that in the fiscal maths, it shows that there is over dependency on the direct tax, which is quite evident if we see the figures of the growth of direct tax both on PIT and CIT of March 24. The personal income tax grew by 21% and corporate income tax around 10 to 10.5. So I think some of the mention which was made by the finance minister while moving some of the direct tax proposals, where 58% of the corporate tax in FY 22-23 was collected under the new corporate tax regime. And in terms of the personal taxes, more than 2/3 of the individual had opted for the concessional tax regime. As we know that there are 2 regimes, the old one with deductions and exemptions, and the new one, the concessional regime without any deductions. She also mentioned that there is going to be a comprehensive review of the income tax at 61, which will be completed in 6 months, which essentially will focus on making that much more easy, readable, and understandable, and also to reduce disputes and litigation which have been piling over the period of time, and also to bring finally the certainty to the taxpayer. But some of the initiatives have already been taken up in these proposals, which we will see, which were on capital gains, TDS, reassessment, and charitable organization. I think one of the key announcements which were there in the next year was in continuation of what happened in 2020 to reduce the litigation and to close all the pending cases. They have again reintroduced Vivad Se Vishwas scheme 2024, and the details of the schemes are there in the annexures, which we will see. Please next. So changes in the personal income tax under the concessional tax regime, they have rejigged the slabs, and essentially it will give benefit of around 17,500 rupees per annum under the concessional tax regime based on the new slabs. Similarly, they have increased the standard deduction, which is currently at 50,000 to 75,000. Of course, this incremental standard deduction is not applicable for those people who are opting for the old tax regime, because there's a separate calculation for which it is there. Similarly, on the deduction for private sector employees' contribution to the pension scheme, which is deductible up to 10%, has been increased from 10 to 14% of the employee's basic salary. This benefit is available for employees opting for deduction on the current new tax regime under the personal income tax. Next, please. There was one practical issue which was being faced by the employees of the corporations or companies, particularly when they have to make some LRS payment which are subject to TCS. And that TCS was not being allowed to be offset against the TDS against salary. So I think in order to alleviate the difficulties of the employees, what they have said is that the employer can take into account the TCS paid by the employee for the purpose of computing the TDS for the employee for the year end, and this is applicable from 1st October. Reporting of foreign assets, and of course earlier there was a much more stringent and strict definition that failure to report for inaccurate reporting of foreign income or overseas assets was attracting a penalty of 10 lakhs, regardless of the value of assets income, with the exception of the foreign banks, where the aggregate balance is not exceeding 5 lakhs. It is now proposed to relax the penalty of 10 lakhs in the provisions of foreign assets other than immovable property, where the aggregate value of assets does not exceed 20 lakhs. This provision is again, of course, applicable from 1st October 2024. Next, please. This is one of the key themes in the rationalization and simplification of the direct tax proposal is the capital gain tax rate. So currently all the short-term capital gain is taxed at 15% or applicable slab rate, and all the long-term capital gains is taxed at 10% or 20%, depending on the residential status and all of the taxpayer. Now they have simplified and unified both in terms of the rates and as well as all the period. First, all the short-term capital gains tax on STT paid equity shares and units of equity linked mutual fund and unit of a business trust will be raised from 15 to 20, which means earlier the short-term gain was taxed at 15, now it has been increased to 20. All other short-term capital gains, which means other than equity shares on which STT is paid and the REITs units and also equity oriented mutual fund shall continue to be taxed at the slab rates, whatever is applicable to the individual taxpayer. As well as the long-term capital gain, which used to be taxed at 10%, all the category of assets have been increased from 10% to 12.5%. And this effect amendment comes into effect from today, which is 23rd July 2024. So which means any transaction happens today and you have to decide whether you have to pay the old rate of short-term or long-term. It is applicable based on the new rates. This is one of the very significant changes which has happened. The second rationalization capital gains is in terms of period of assets, holding period of assets. both financial and non-financial. And we used to have varied from 12 months to 24 to 36. Now there are only two holding period. One is 12 months and 24, determined based on whether it's a short-term or a long-term capital gain. In other words, for all listed security, the holding period will be 12 months for the calculating long-term, and for all others, it will be 24 months for the long-term. Unlisted bonds and debenture will be deemed to be short-term capital gain, irrespective of the period of holding. That is one carve-out which has been given for unlisted bonds and debenture. Again, this comes to effect from the 23rd July today. One of the very silent thing in the fine print which one realized is that as they have increased the rates from 10 to 12.5% on the long term, there used to be indexation benefits which was applicable to all assets, but most importantly for land and building, that has been removed, and which is now the indexation is removed for all category of assets. So which means that the calculation which we used to have the interpretation issue with indexation so much rate, without indexation so much rates, has been completely discontinued because there used to be a lot of dispute on that. And also from economic context, the indexation was always given because tax, it was never to tax inflation. But now by removing this, it suggests that yes, they are taxing the inflation also. Next. The second big theme in this proposals on the direct tax side is rationalization of TDS rates. And there are several sections of the TDS rate, basically 7 to 8 of them, where the existing rates were around 5%, and it has been reduced to 2% in most cases. And for e-commerce participant, it has been reduced to 1 to 0.1. This will be a big boost for the e-commerce operators, and because most of them had made the representation that given this margin at which they operate, 1% seemed to be very high, and probably the government proposal seems to have listened to that. Similarly, a payment of salary, remuneration, interest, bonus or commission paid by the partnership firms to the partners. There was no existing TDS rate. Now they have introduced a new rate from 10%. Next. This was another surprising is that corporate income tax rate for the foreign companies, which was always at 40 and it used to be above 40, but for the last decade or so it was always on 40, has been reduced to 35%, and the effective headline tax rate including surcharge and education cess will be around 38.22. So still with these surcharges, it used to be 42-43%. It has been reduced by 3 to 4%. The next big surprise, of course, was equalization levy. I must clarify that there were two stages of equalization levy. One was introduced in 2016, essentially for advertisements by residents to non-resident at the rate of 6%. And in 2020, there was a second introduction of the equalization levy at 2%. And I think there was a lot of stakeholders had petitioned to the government saying that the 2% equalization levy, the scores seems to be very wide. It included supply and services, where there was a lot of ambiguity, and also the burden was also felt on particularly the digital transactions. So what they have removed essentially is the 2% equalization levy. Also, if you recall, there was a US Trade Pact 401, which is called, and the government had announced saying that this is a temporary measure of 2%, and this will be soon removed. And the date which was given was 30th June. And probably that is also one of the reasons that they discontinued 2%. But having said that, 6% equalization levy, which was introduced for a limited activity in 2016, continues to be there. Next. This is in order to encourage the foreign shipping owners who are running the cruise, and if they were to operate in India, for them, 20% of the revenue on the deemed basis, the operators will be charged as business income. and the existing presumptive tax regime for shipping business of non-resident is no longer applicable for such domestic cruise operator. Currently, we have a regime of the deemed taxation basis for the foreign operated shipping business, and now they have carved out in order to encourage the foreign ship owners who are running the cruise business in India and to attract the tourism and others. They have created a separate rate for 20% on the revenue. And similarly, if there is a lease rental income between two related companies having the same parent, and this will and the sister company, there will be exemption and there will not be any taxation on that. Next. Gift City, of course, there were 2-3 expected provisions. One is that the first time they have come out with a tax framework for the retail schemes and ETFs. Currently, non-retail scheme set up in the IFC as category 3 AIF and having only non-resident investor are regarded as specified funds. Certain income of the specified funds are exempt, for example, capital gains on debentures and debt securities. Of course, interest and dividends are taxed at a relaxed rate of 10%. Now they have introduced a new scheme for tax scheme for the retail schemes and ETF, which are regulated by IFC, which satisfy certain conditions which will be prescribed by the government, will be regarded as specified fund. Similarly, under the transfer pricing regime on thin capitalization, we know that interest payment made to non-resident associate enterprises is restricted to 30% of the EBITDA, with NBFC banks and insurance company being exempted if the loan is taken from them. Now a finance company set up in the IFC under the IFC authority will also be exempted provided it satisfies certain conditions which will be prescribed in due course. So this gives an opportunity for companies to set up the captive treasury activity there in IFC, because now there will be an exemption given if they were to set up a captive treasury activity and from there they lend the loans. Next. Similarly, tax exemption to the clearing corporation set up in IFC, specified incomes of the core settlement guarantee funds set up by the recognized clearing corporation as defined by the SEBI and were exempt. Now this definition is getting extended and recognized of clearing corporation, which are expanded to include clearing corporations set up under the IFC. They will also soon get this exemption. Lastly, on IFC, exemption of venture capital funds, where the source of credit and funds are not explained, the same is subject to income tax, as we know under the current regime. Further, it is also prescribed that the creditor shall was required to be explained. This requirement of source to be explained was exempted by SEBI for the registered venture capital fund, only limited to the SEBI registered venture capital fund. Now this definition of VCF is expanded for all those VCF which are set up under the IFC regulation because of the boost of creating the venture capital fund within the IFC regime. Next, please. The Vivad Se Vishwas scheme, which we just saw in the beginning, is also forms part of the proposal under the annexure. Essentially, it sort of gives a table of tax, interest and penalty and the due date when the appeal is filed, and also the scheme it can be appealed before 31st of December. So if there is a tax arrears of tax, interest and penalty, and if the appeal is filed after 31st January 2020, but before 22nd July, you have to pay only, the taxpayer has to pay the disputed tax demand only. And if the taxpayer pays the tax after 31st December, but on or after 31st January 2025, then apart from disputed tax, they have to pay extra 10% tax on the disputed tax. Same is the case when the appeal is filed before 31st January, they have to pay disputed tax plus 10, but after 1st January, it is disputed tax plus 20% of the disputed tax. If there are any arrears on interest or penalty or both, similarly, they have said that 25% of the disputed tax or penalty has to be paid depending on when the scheme is availed by the taxpayer before 31st or from post-January. Interest and penalty similarly, if it is appeal is filed before 31st of January 2020, 30% of the disputed interest or penalty, or later than that 35%. What is important here is that, as we saw in the last VSP scheme, this settlement amount payable is reduced to 50% of the tax disputed amount, where the appeal writ SLP is filed with the tax authority, which means the taxpayer has won in the High Court and the tax authorities have gone to the Supreme Court under SLP. Similarly, where the issue of the taxpayer is covered by a favorable ITT High Court decision in taxpayer case. In both this scenario, instead of paying the 100% disputed tax in the first two rows on the table, the taxpayer has to pay only 50%. And the scheme, when it will come into effect, will be notified by the central government. Two important things in the final print we just saw, that they have for the included those cases which are which have got a DRP order, some of the foreign companies which have got DRP, and also 264. It appears that these two may also be included. Next. Taxation of the buyback proceeds as dividend from shareholder. Few years back, this scheme of the buyback tax was introduced, and the domestic company have to pay during the buyback 23.30% on buyback of shares, and the same is used to be exempt in the hands of the shareholder. Now the buyback tax is completely abolished, and the characterization of the receipt in the hand of the recipient has been changed from capital gains to deemed dividend. In other words, on the buyback, when the taxpayer or the shareholder receives the money from the company on the buyback, they will be treated as a deemed dividend. Hence, no deduction of expenses will be available. Domestic company which is doing a buyback will have to withhold 10% from payment to the resident shareholder, and the cost of acquisition of share will result in capital loss and allowed to be set off in carry forward in against the capital gain. In the memorandum, they have given an example as to how the capital loss is computed and how it can be set off in a very simple example they have given. This again comes into effect from 1st October 2024. The next one is reporting income from let house property. Apparently, it appears that some taxpayer who are receiving rental income from letting out the house property were showing this as income from business or profession instead of income from house property, thereby reducing their tax liability. Now they have clarified that this such in rental income has to be necessarily shown as income from house property instead of income from business or profession. Capital gains exemption on corporate gifts. There were several judgments of the corporate gifts of shares, particularly of unlisted scenarios, where ex-corporate used to give the shares to the Y corporate, and the courts have held that in the absence of any specific anti-abuse provisions, these are all allowed. Now this has been plugged. Now the exemption will be applicable only to such transfer by individual HUF and not by corporates, because under the individual HUF, there is one category because of love and affection, one can gift any property to their relatives as defined in the law. Gifts by corporate is considered as taxable, and fair value provision will apply for computation of such gifts. The next one is cost of acquisition of equity shares under offer for sale in IPO. On withdrawal of the capital gain exemption in way back in 2018, when they brought in 10% tax on the listed security and provided for computation of cost of acquisition considering the market value on 31st January 2018 when it was introduced. This provision created an ambiguity of computation of fair market value of equity share transferred pursuant to an offer of sale under an IPO or during the course under an IPO. Now the fair market value of such equity shares will be costs of acquisition adjusted to cost inflation index up to 2017-18. And this amendment will again, it's a retrospective and it starts from assessment year 2018-19. So all those people who have taken the advantage, I guess, will have to be paying tax on those based on this amendment, which has retrospective 2018. Next. Widening of the tax base, preventing misuse of expenses deduction by the insurance business. Now it is insurance business are essentially governed by specific code, which is contained in the first schedule of the Income Tax Act. Now it is proposed that the restriction of the expenditure of such insurance business will also be covered under Section 37 of the Income Tax Act, which essentially controls the expenditure by the business enterprises. The next big change which happened in the capital gain regime is that for two categories, they have increased the rates of the STT rates, security transaction tax. One is the transactional sale of option in security and the transactional sale of future in security, essentially to ensure to discourage the individuals and the retail segment to participate in F&O. Only these two changes, they have made it expensive by increasing the STT rates. Next. Specified mutual fund scheme. These are in two parts. Part one is that currently the units of specified mutual funds are considered as short-term capital gains irrespective of period of holding, as we saw in the amendment in the capital gain. Specified mutual fund currently as defined as which will have not more than 35% of total proceeds invested in equity shares of domestic company. With a view to boost both the debt and money market and also to bring a clarity, there's a new definition which is sought to be introduced for specified mutual fund, which essentially means that a mutual fund by whatever name called, which invests 65% of the total proceeds in debt and money market instruments and classified and regulated by the SEBI, or a fund investing 65% or more in the total proceeds and units of a funds report afford, which means similar like specified mutual funds. The second amendment, which a proposal which has come is unlisted debenture and bonds are now deemed to be short-term capital gain asset irrespective of period of holding, and this effect comes from today, which is 23rd July 2024. Next, please. On the rationalization of the reassessment provision, I think we are going to and fro. I think finally they have brought in the time limit of issuance of reassessment proceeding, which used to be there a few years back. They made it 10 years, back to 5 years and 3 months. And similarly, on the prosecution of the delay in deposit, there used to be a prosecution and then, of course, compounding, even if there is a 1 day or 1 week delay. Now they have made an exemption that such prosecution provision has been introduced for the delay in deposit of TDS, as long as it is deposited before the due date of filing of the TDS return, not the tax return, but the TDS return, which are filed quarterly on that. Rationalization of time for filing appeal, which we all know that 60 days is time is given after the CIT appeals order to file an appeal to 60 days. And there was a controversy as to when this 60 days is counted, and this has been reduced to 2 months from the end of month in which the appellate order is communicated to the SSC or PCCIT. Next, please. Continuing with the rationalization measure, nil and withholding certificate, which was the benefit available to most of the TDS provisions. Now it has been on certain specified payment. Now the such specified payments has been expanded for purchase of goods of the value of exceeding 50 lakhs, which are subject to TDS. Otherwise, they were not eligible for 197 lower or nil tax benefit. Finally, one big thing, as we all know that there are 350 cases are pending under the old AR, which got transition as a Board of Advanced ruling, and several applications were ready to be withdrawn because of the long pendency of these cases by the taxpayer. They want to withdraw and pay the tax and get on with it. They have made an amendment in the Act saying that those cases where it has been not admitted can be withdrawn by the taxpayer on or before 31st October, and the Board of Advanced ruling have to pass the withdrawal order by 31st December. One catch here, which on the fine reading, it shows those cases where it has been admitted this provision may not be necessarily applicable. That is one of the interpretation coming. Probably, I'm sure the CBDT will clarify this, that it should be applicable to both, whether admitted or not admitted. The big surprise which came, and probably for a very good reasons, is the removal of angel tax provision. There were a lot of tweaks and a lot of representation done. That in spite of the tweaks, things on the ground were not very conducive to the startups, and they were subject to a lot of queries by the authorities. Finally, they have taken a very bold decision to remove the angel tax from the Income Tax Act. So, and the last two is that power of the TPO. Currently, the TPO generally is referred by the assessing officer. So moto, he can examine any international transaction which comes to it. But now they have increased their power of the TPO to also examine so moto any specified domestic transaction as well. He can do, although may not be referred by the AO. And the next last provision, of course, is limitation of passing an order. Hitherto, we never had any time limit for non-resident, and it used to be that any time they can open up. Now they have put a 6-year time limit, even for the non-resident, based on few High Court judgments which were delivered a few years back. So these were the broad proposals on the direct tax. One, of course, what we have not covered, there have been 3 of proposals on the trusts and others, and those we have not covered, but broadly these are the proposals. Over to you, Sameer.
No, thank you, Ganesh. And obviously, there was a lot to cover and much more than what was mentioned in the speech.
Yes.
So, the fine print, of course, had several provisions and some very far-reaching provisions as well. So we'll come back, Ganesh. There have been some questions which are coming, but let Uday finish the indirect tax proposals and then I'll come to the questions.
Sure.
Uday, over to you.
Thanks, Samir. Thank you all for attending this session. Can I go to the next slide? As usual on the customs side, the government has kind of tinkered along with the duty rates. I mean, what the finance minister kind of suggested in the speech also, that her endeavor to kind of go about rationalizing duty rates for primarily supporting domestic manufacturing, enhancing or incentivizing local value addition, promoting export competitiveness, have actually driven a lot of changes that have been suggested in this particular budget. And I mean, there is a history to it. Way back in budget of 2020, a comprehensive review of all exemptions, conditional exemptions were kind of initiated. There was actually a initiation or an insertion of a section which automatically lapsed all conditional exemptions by 31st March of the next couple of years. And thereafter, every couple of years, these exemptions are being looked at. Now, even in the present, I mean, in 2022, about 350 plus exemptions were reconsidered and possibly kind of suggested for phasing out. In the present budget, 2 or 3 things have happened. This 2-year period was considered to be a little bit, I mean, promoting or not giving certainty. So, there had been some amount of extension of larger amount of, period of exemptions that has been granted. About 30 exemptions have been, the exemption has been nominated or validated till 2029. 126 exemptions have been proposed to be continued till 2026. And there are about 28 exemptions, concessional rates are being lapsed with their end dates being this September 2024. A lot of further duty rationalization has been proposed in relation to several sectors. Some of them are related to, the PLI sectors, related to the PMP that has been kind of announced earlier. A lot of this is also in relation to sunrise sectors and so on and so forth. So a lot of those kind of amendments aligning the duty rates to sectors which the government wants to do a targeted promotion of, as this was in the case in the past, has happened in this particular budget too. Can I go to the next slide? You can go to the next. Yeah. Further, what has been kind of announced in this particular budget is a comprehensive review of taxes rates. The earlier was an exemption kind of a review. Now, what is being proposed now is a comprehensive review of tax rates or duty rates over the next 6-9 months, primarily driven by 2 or 3 objectives, which is ease of trade, removal of duty inversion, and dispute reduction. So anywhere there is a dispute, they just want to kind of go about amending tariffs and so on and so forth. So I'm moving ahead. And certain exemptions are now proposed to be, as I mentioned, lapsed in 2024. The job work purposes, exemptions of goods imported for job work in relation to a execution of an export order there is an exemption there under notification 32 of 97. That's been now valid for the next 2 years. One would think that this would be revalidated subsequently. Till date, there's no kind of sunset clause for this particular exemption to date. So that is an important one. There are other trade facilitation measures that have been introduced primarily for MRO, wherein the time limit for export of aircrafts of repairs related to aircrafts and vessels. The re-export was supposed to be done within six months to extended by 1 year. Now another incremental six months extension is kind of allowed, and in case of warranty, the time limit for duty-free re-import of goods related to warranty has been extended for 2 more years, okay, than what was available earlier. We can go to the next slide. The other change amendments that have been proposed are in relation to imports under trade agreements. This proposal is to enable acceptance of different types of proof of origin, including self-certification. This has primarily been done to align with the newer FTAs, especially the India-European Free Trade Association and India-Mauritius, and in relation to export of goods, India-EU. FTAs that have been recently kind of executed. So these changes have been made to align with those. Again, there is no dilution of the Karotar provisions. So this is just allowing certain certification to be done for import and export with where we have foreign trade agreements. There has been a proposal under Section 65 to kind of empower the central government to specify certain manufacturing or under the mover scheme, certain class of goods for which manufacturing may not be permitted or licensing may not be permitted. This is to actually deal with a Delhi High Court judgment in the case of ACME. It was a recent judgment in May 24, whereby the Delhi High Court basically suggested that a CBIC could not impinge and restrict licensing or granting of licensing by way of instructions. So they have now enabled the central board to do that. And there have been certain modification in tariff entries, as I was mentioning earlier. Let's move ahead. Okay. On the GST front, the amendments obviously have come from the announcements or the discussions that have happened in the 53 council meeting. A lot of it was in a sense announced at that point of time. What we've kind of gone ahead and done is broken these amendments into 2 broad baskets. Primarily, they are targeted to managing controversy and litigation, both for the future and the past. I'll take the future first. They've introduced Section 74A, and that basically, in a sense, uh, rationalizes in a way the limitation period for all kinds of offenses. So till date, what's been happening is that where there are bona fide cases, the time limit for issuance of notices for non-fraud cases and bona fide cases is 33 months from the due date for annual return, and the penalty is about is 10%. Okay, um, is 10%. For fraud cases, the limitation period was 54 months, and the penalty was almost 100% of the tax demand. Now, both these, I mean, now the law for the issuance of demands doesn't kind of bifurcate between fraud and non-fraud or bona fide and fraud cases. Now, for all cases, the time limit for issuance of these demands or these show cause notices is 42 months, but the orders can be issued by 54 months or 6 months from the date of annual return. So there is a significant increase in the time limit for issuance of show cause notice for bona fide cases and also kind of passing orders. The earlier similar time limit was 36 months for bona fide cases. 36 months effectively can become 60 months for issuing orders. The show cause notice is 42 months. So that I think is a big change that has happened. There have been some kind of tweaking related to penal consequences, both in bona fide and fraudulent cases. The key element is that earlier any tax charged in case of fraudulent cases, credit would not be available to the recipient. That particular restriction has been removed. This is a very, very good change. Again, as defined or as kind of suggested during the 53 Council, they have tried to rationalize the maximum amount of pre-deposit in case of appellate authority. That has been executed by this change that has happened. Now it's 25 crores CGST and SGST each. In case of the first appellate authority, it was 25 crores, now it is 20 crores. And in case of the second appellate authority or the GSTAT, the overall maximum is 50 crores. That has now been kind of reduced to 20 crores. So that has been some rationalization done. And again, other amendments were related to the GSTAT time filing. As and when the GSTAT will get filed, they will notify the date. And more importantly, now authorized representatives can be, there has been an amendment and they've inserted a particular section 71A. This is again a very good change where authorized representatives can be allowed to appear for summons before a proffered officer. So that again is a very, very good change. The way it is implemented, we will need to kind of see. The next slide, please. The other kind of change has come by insertion of a section 11A. This is paramateria. There's other section 11C that was there under central excise. What it basically says is that the Central GST Council is, in a sense, allowed to waive taxes if there has been a short payment of taxes or non-payment of taxes due to generally prevalent trade practices. So this is very similar or parameteria to the 11C that was there earlier. The point to be noted is that it should be an industry issue, not a generic individual issue. Can't be obviously considered under section 11A for this. Several pending industry issues are likely to be considered now with the insertion of 11A. Okay, again, a good kind of change to manage past litigation. ITC related to 1st July 2017 to March 21, there has been some amount of extension for specific kinds of missouts has been allowed. Again, this was to kind of deal with certain cases and remove old litigation. And by way of an amendment to Section 9, What has been proposed is that undenatured extra neutral alcohol or rectified spirit used for manufacture of alcoholic liquor for human consumption should be excluded from the levy. They didn't do it by kind of granting an exemption, but they did something similar as it is in the case of petroleum products. So one would think now that the state excise, if would be the next bit to kind of, they will try to impose that. How will they impose? We'll need to kind of see. Would it require a change in constitution? We'll need to see that. Going to the next slide, please. Another very big change that has been brought in place is the kind of a waiver or a dispute settlement scheme. The period for the dispute settlement scheme relates to any order or a show cause notice issued for the period 2017 to March 2020. It basically suggests that in case the tax is paid till a notified date, the PIB had suggested that the date would be 31st March 25. But if there is a or tax has been paid, then the interest and penalties will get waived off. This doesn't include erroneous refund cases. Whatever has been paid would not be kind of refunded. Okay, and if interest and penalty has been paid in the past, that will not be refunded. Appeals and writ petitions would need to be withdrawn, and matters concluded under this provision cannot be appealed in general. So they really want conclusion of kind of tax appeal. We'll see what the impact of this would be. Going to the next slide. And quickly, some of the transitional issues have been kind of handled. Some of the insurance past litigation related to co-insurance and reinsurance have been deemed to be non-supply. But having said that, this amendment is prospective. One would hope that with the insertion of 11A, the past litigation would be kind of stopped in general on an as-is where-is basis. So those are the big changes that have kind of happened. And over to you, Samir. I know I've rushed a little bit.
No, I think that's great. Thanks, Uday, for covering that off. Again, quite a lot of changes. So I think what we'll do is we will quickly move to answering some of the questions that have been posted by you guys. Please do send in your questions still, and we'll try and cover as many as we can. And otherwise, we will, of course, reply back offline. So I'll just pick up the questions now. Ganesh, I think there is, of course, a lot of excitement with the Vivad Se Vishwas scheme announcement. And I know that, there is a lot of detailing around the scheme, but two separate questions. One is that if there is an application for revision of order under 264 that has been filed, would this scheme look to cover that?
Yes, that is covered under the VSV.
Okay. And the second is, again, because of the draft assessment orders that come up in the DRP, if the objections have been filed before the DRP, but it is still pending for disposal, then can you opt? Can the taxpayer opt for the VSV scheme?
Yes, you can opt.
Okay. So that was quick. I did want to, before I go to the next question, Arnav, I think you've heard some of the tax proposals and of course, again, they are very detailed and its time has been short. But just your gut feel about what you've been hearing in terms of, the direction of travel, and how do you look at this from an industry standpoint?
I think, as I said in my opening comments, that there is quite a bit of emphasis on simplification, and that's clearly evident in some of the provisions. So that's the direction which I see, and I see it as positive. Of course, I mean, there are some fine prints which we still have to all study, but overall, I think the direction of simplification is very clear.
No, absolutely. And also, addressing real issues, from a compliance and from a litigation standpoint, so covering all of that, both on direct and indirect side, I think that's pretty comprehensive. Okay, thanks for that, Arnab. I'll just pick up a couple of more questions. On the indirect tax side, Uday, this question is, more from the telecom or electronic sector. The question is that the FM called out for reductions in custom duty on mobile phones in the budget. Any takeaways for the electronic and telecom sector in the budget?
So, Sameer, what has really happened is that mobile sector or mobile phone sector, if I can call it, has reached a state of maturity. Now, almost 97% of the domestic industry demand is being satisfied by domestic manufacturing that's happening. And therefore, the government has now started rationalizing the duty rates on mobile phones from 20 to 15%. Further, there have been certain reduction again from 20 to 15% for PCBAs on that, and I think charger adapters. And again, that's because a lot of PCB assemblies, what they call is that SMT and surface mounting technology, that particular activity is being done within India. And so they've started relaxing some of the duties on that front now that the value addition is happening in India. But on the other hand, on the telecom side, they want to kind of push it ahead on incentivize it. So the duty rates for those have kind of got an increase from 10 to 15%. Having said that, a large part of now this expenditure on the telecom and the investment that is going to happen in BSNL, okay, for the 4G rollout will require a lot of telecom equipment kind of manufacturing. So they want to kind of incentivize that, and that's why the duty rate kind of tweaking for telecom equipment. And we'll see more and more of it as we go along.
Okay, that's good. That's good. DK sir, I can come to you for this question. This is on tax GDP ratio. And this is increased from 10 to 11.8% in FY25. Do you expect this trend to continue in the medium term?
Well, Sameer, because this increase has been based largely on just maintaining a buoyancy of higher than 1, I think
Right.
this is something that is easily available as long as the direct taxes continue to remain buoyant. And therefore, if we are able to show a higher than 1 buoyancy for a period of 5 to 10 years, we should experience a tax GDP ratio in the range of 13 to 14%.
Okay, I think the question really, if I may ask you, this is on my mind, is that, of course, with all the tax litigation and settlement schemes that have been provided for in the VSV, right? How much of the budgeting for that would have been done in these numbers as well, right? So, so that does give the, so what you rightly said that the buoyancy is there, but definitely the performance can be better than that.
Yes, yes.
Okay, so just a couple of questions more. Maybe I'll answer some of these. Is there anything on Pillar 2? So, of course, nothing specific on Pillar 2 in the budget, right, Ganesh? There's nothing that we came across over there. So let's see how that goes going forward. The other is the increased 14% NPS contribution applicability. From which year is it? I think
assessment year 25-26.
Right. So basically, it is from this financial year
24-25. Yes,
correct. So this financial year itself. Correct. That's right. One or two more questions. Uday, on these new section 74A. Right. The question is, what is your perspective or any insights you can share as to how this will impact the industry? Uday, you're on mute today.
Yeah.
Yeah.
So a couple of things. One is that this actually extends the limitation period for bona fide, and that therefore for bona fide taxpayers is actually slightly increasing the uncertainty. So I think that obviously is something that perhaps people would want to kind of see, especially with the kind of digitization that's there. The call would have been to reduce the limitation period for bona fide. So that is one bit. But on the other hand, two things that have kind of happened, and I think if you look at it holistically, one is that they have not kind of, in a sense, allowing the recipient or the customer to claim the credit. So the denial has been removed. So that rationalization helps out. The second bit is the insertion of Section 11A, and that Section 11A is used judiciously to kind of handle past industry issues, I think, and aggressively used for removing litigation that will kind of bolster the certainty that the government and that the industry kind of requires. So all in all, holistically, they've tried to kind of do a couple of things to grant more certainty, which kind of bodes well.
Okay. All right.
One question, Sameer, probably.
Yes.
I saw that there is a lot of confusion, which we can clarify. One is that having removed the indexation benefits, the question which is being asked more importantly for real estates is that whether the FMB as on 1st April 2001 can be can be taken or not. The answer is yes, because FMB is dealt in Section 55 and there is no amendment vis-a-vis that. Whereas indexation is dealt in Section 48 where they have removed it. And finally, just now after the budget, FM's and Finance Secretary's press conference, Money Control has just come out and clarified saying that FMB will be applicable.
No, absolutely, absolutely. Thank you for that. But since you've asked that question, there is another question for you, Ganesh, on equalization levy. And, is it on all kinds of equalization levy that it has been abolished?
No, only the 2% one which is abolished, which I said that 2016 when it was introduced at 6%, that still continues to be there.
Okay. And maybe I'll just take two more questions before we close. Uday, this is on the GST and penalty waiver. The question is, can we pick and choose a particular issue to settle instead of paying on all the issues?
So that's not coming out of the amendment, and also the PIB that was issued seems to suggest that the entire tax in a notice needs to be deposited. Okay. Again, this would be something that we would want to kind of go back and talk to the government to kind of make it slightly more expansive.
Right.
So that is one. There is one more question that has come, Sameer, on the same, let's say, waiver. The question says that what happens when there is a pre-deposit that has been done for the first appeal? Would that be adjusted and only a differential amount to be paid? I would think effectively only a differential amount would need to be paid to claim the amnesty scheme, ideally. So that should be okay.
Yeah. And I think one last question I'll just pick up. I think it is on IFSCA. The question is basically to clarify actually that the retail funds and the ETFs in AIF, as far as the exemption is concerned, what does that cover? So what we said, Ganesh, is that basically it is in the context of gains other than equity gains, which is on debt and securities.
That's right. Derivatives and yes.
Correct. Yeah, correct. So that should clarify that point.
Correct.
Okay, friends, we are almost at the end of our 90-minute session, and I know it went through very quickly. Or at least I felt it went through very quickly. But since there was so much to cover, time is always short. Thank you very much, Arnab, first of all, for joining us today and providing your comments. And I want to also thank all my panelists for very quickly putting together the presentation as well as making some very well-made points. As we had said, when we started the session, it does seem that, the trade-off between capital expenditure versus reduction in fiscal deficit. I think, clearly on the reduction in fiscal deficit to GDP ratio, DK sir, you will agree that, they have gone below the estimates that were being put out probably at 5% or 5.1. But on the growth side, yes, there is potential probably to achieve more. But with that, we bring this session to a close. And thank you everyone for joining us here today. We value your time and thank you for joining EY's webcast on Budget Day. Thank you very much.
Thank you. Thank you.
Thank you.